This video may be the most important video I ever make on this channel because I'm going to share with you an unfortunate truth that no one wants you to know about. None of the fake gurus that are teaching day trading and investing on YouTube, for example, they're not going to tell you this truth. Also, the mainstream financial media, they don't want you to know about this truth. So what is it that they're hiding from you? They're hiding from you this fact: markets are random. You cannot accurately predict where an underlying asset, whether it be a stock or ETF, commodities, futures, currencies, whatever it is you're trading, you cannot accurately predict what the next candlestick's going to be, whether it's green or red, whether it's up or down. You can't do that. There is no magic formula. There is no technical indicator that you can view. There's no fundamental analysis that you can use to accurately and reliably and consistently pick the direction of a market. So the unfortunate truth is markets are random, what the fake trading gurus don't want you to know. So let's talk about the problem of picking direction. This is probably one of the most common questions I've been getting recently is, how do I pick a direction? How do I know if a stock is going to go up in price or down in price? Well, the truth is you really can't, right? There's no way to predict that. But really the problem with trading certain financial instruments like stocks, like Forex, is they're essentially 50-50 shots and you have to pick a direction, right? Because stocks, for example, they can either go up in price, which is great if you happen to be long shares of stock, or they can go down in price, which is bad if you happen to be long shares of stock. There's essentially a 50-50 chance that the stock is going to go up or down, right? It's a coin flip. And like any coin flip, how can you possibly predict or guess the outcome of the next coin flip? If we're actually talking about coin flips, actual coin flips with a coin, is there any way you could possibly predict heads or tails the next time I flip a coin? Obviously, the answer is no, but many people think they can do that with trading instruments like stocks, Forex, futures. They think they can accurately, reliably predict that next coin flip. And the truth is, there's no way. And the reason there's no way is because there's no way to predict an efficient market. If you have efficient, liquid markets like we have here in the US. I mean, the US stock exchange, the US market is by far the most liquid stock market, and everybody kind of trades in the American markets. And the reason is because they are the most liquid, they're the most efficient markets. And if it's an efficient market, it's a fair market. And if it's a fair market, you really can't game the system. Although many traders look for plays like arbitrage plays and ways to game the system, ways to get an edge, maybe an unfair edge, but those kinds of ways to game the system, they just don't exist in an efficient marketplace. So efficient markets are random markets. So this is a hard pill to swallow for most traders who want to believe that they can predict market movement. But go look at a stock chart. Go look, matter of fact, let's go ahead and I'll pull up my trading platform. We'll look at, well, I'm already on Google. Let's pull up a chart for Google. I mean, look at Google. You know, all these candlesticks, they move up and down. You know, there's a lot of red, a lot of green. Overall, it looks like for the last year or so, Google has moved up and it's had a general tendency to move up. But, you know, just because it had that general tendency, there's a lot of down moves, right? There's still a lot of red candles, right? So you never know what that next candle is going to be. You never know, especially short-term trading, where it's going. It's a really a kind of a zigzag motion. Now that zigzag motion may drift up or it may drift down, but it's going to be a lot of back and forth two-way action. And neither fundamental analysis nor technical analysis can predict where a stock is going to go in the short term. Fundamental analysis is looking at the balance sheet and the income statement and listening to earning calls and all of that. Fundamental analysis is completely worthless if you're a short-term trader. Fundamental analysis will not offer you any benefit at all unless if you want to do it because you're holding stock long-term. So you're a long-term investor, you're going to hold some shares of stock for multiple years, maybe even a decade or more. Then maybe doing some fundamental analysis on that company, that kind of makes sense. And certainly that's what a lot of fund managers do. They spend all of their time doing fundamental analysis on these companies that they're buying, you know, massive amounts of shares. But they're doing that mainly as a way to cover their rear ends, because if for whatever reason that company that they're purchasing shares of, it if it completely collapses or tanks, at least they have an excuse, a reason. They can point to a reason why they bought that company. Look at the fundamentals. The fundamentals were so fantastic. How could I have possibly known that the company was going to completely tank, right? Well, the thing is, if markets are random, there's nothing they could have predicted anyway, but they're using fundamental analysis as kind of a way to tell people that they had an actual reason to buy that company. And technical analysis really can't do anything for you either, because technical analysis really can't predict what a stock is going to do in the near term or in the long term. Technical analysis is not future looking. Technical analysis, all these technical indicators that people use, they're all based off past price action and volume. So it's a look into the past. It's essentially looking at what the candlesticks and the volume bars did, and then they put some kind of magic formula to it to create these various, hundreds of different indicators out there, but they're all based on the actual price action and volume that you're looking at on a standard chart. It's just a different way to interpret that information. Now, if markets are in fact random, which again, many financial experts do believe markets are random, and I've kind of grown into accepting that fact as well. Well, if markets are random, then that also means they're not cyclical, because many traders believe in market cycles where they see patterns in a chart. They see, hey, this stock did this, and then it did that, and then it did this again, which means it's going to do this other thing again. And it's like, no, that's not the way markets work. If markets are random, then by that very definition, you're not going to have patterns in a market. There's not going to be this cyclical nature that you can, set a watch to and somehow predict. In truth, if you stare at any stock chart long enough, you will find a rationale for any prediction that you can imagine. For example, if in your heart of hearts you really want to get long a stock, it doesn't matter what that chart pattern looks like. You can stare at it long enough, you'll find something that kind of validates your already existing belief, right? You'll sit there and make up a reason for getting long that stock other than just a gut feeling. Even though at the end of the day, the gut feeling is pretty much all you have, you'll stare at that chart long enough to eventually convince yourself that that is the right decision. So let's talk a little bit more about fundamental analysis versus technical analysis. So fundamental analysis evaluates stocks by trying to gauge their actual worth using the fundamentals of the company, like earnings, expenses, assets, liabilities. So we call the people that use fundamental analysis primarily, that we call these people fundamentalists. And these fundamentalists put in a lot of work sifting through all this data, listening to conference calls, evaluating the products of a company. They'll buy products or services of a company they're interested in order to learn more about that product, in order to gain an edge. That's what the fundamental analysis is all about. And technical analysis is quite different. We're not interested in the fundamentals of the company. We're interested in chart patterns. We look at the patterns of the chart. So if I go back to, TASTYTRADE, we're looking at the charts and we're going to draw things on the chart. We'll draw support and resistance levels. I'll just draw a line anywhere, right? I'll just draw price levels all over the place. Maybe this is a range that I've identified or some kind of channel, or, I'll look at these indicators that I've added to the bottom of the chart here. It's the MACD and the RSI. This is the MACD saying that the stock is overbought or oversold. It's the RSI saying the stock is overbought or oversold. That's what technical analysis is. It's about looking at those chart patterns and those technical indicators. But again, those technical indicators, they're all based on past price action and volume. So it's a look into the past. It's never a look into the future. And especially with shorter term traders, day traders, most of these people are technicians, and they're the ones that have all of this crap drawn all over their charts, right? They're drawing lines all over their charts, support lines, resistance lines, trend lines. They're using all these indicators. They've got about 5 different moving averages on the chart, Bollinger Bands, RSI, MACD, stochastics, and whatever else they can put on their charts. And they've got so much stuff on their charts, you can barely read the candlesticks anymore. So does technical analysis or fundamental analysis work? Does either one of these systems actually work? And is one better than the other? Well, it depends. Some traders are fundamentalists. Some traders are technicians. Some traders are a combination of fundamentalists and technician, and some traders don't use either fundamental analysis or or technical analysis. So why is this the case? Why do some traders use one or both of these forms of analysis while other traders don't use either one? Well, the reason for this is actually pretty obvious if you think about it. It's because neither fundamental nor technical analysis can reliably predict the market. So they don't really do anything. So some traders will use it. Great. I mean, it doesn't really do anything for them. Some traders don't use it, which is fine too, because it wasn't going to do anything for them anyway. That's why some traders use these forms of analysis. Some traders don't. In the end, does it really make a difference in their trading? No, not really. Now, what you should really be on the lookout for is be on the lookout for anyone that actually claims that they can predict the market using a tool. Because anybody's trying to sell you something, anybody claiming that they can accurately, reliably predict price movements through some kind of system of technical analysis, some proprietary trading method that they've developed, that person is almost always a scam artist. They're almost always trying to sell you something. Don't fall for it. So the reason that neither fundamental nor technical analysis works is because, of course, markets are random, and the sooner you accept that, the better. Traders that understand the efficient market hypothesis are far less likely to bother with fundamental or technical analysis because it's kind of wasted effort. I mean, why look at that stuff if you know in your heart of hearts that it doesn't matter, right? Once you realize markets are random, you're not going to bother with all of that fundamental or technical analysis. Unfortunately, many traders have not been exposed to the efficient market theory. They haven't read A Random Walk Down Wall Street yet. If you haven't read that book, by the way, I should link to it in the description of this video. That is probably one of the most important books on trading and investing that you will ever read. A Random Walk Down Wall Street by Burton Malkiel. Check that out. I'll put a link in the description. But, many traders haven't learned about efficient market theory yet. And thus, they still believe that there has to be a way to predict the market. They still believe there's a magical formula out there that can predict whether that next candlestick is going to be a green candle or a red candle. So even though neither fundamental or technical analysis can predict the future, they can't predict what a market's going to do. Are they completely useless? Well, not necessarily. I think for short-term trading, like what I'm teaching with the super wheel option strategy, primarily, I'm only in a trade for just a few weeks at most. And for that, I think fundamental analysis is completely worthless. Unless you're holding a stock for multiple years at a time, there's really no reason to dive into the fundamentals of a company. For one thing, it's a really big time sink. You're going to have to waste a lot of time for something that, again, for short-term trading, really doesn't offer you anything. But unlike fundamental analysis, I do think technical analysis can be useful to a trader as long as they understand what technical analysis is and what it isn't. If you think technical analysis can predict the market, then you are gravely mistaken. In that case, technical analysis is completely worthless. But if you are using technical analysis to help interpret past performance, because again, technical analysis is always about looking at past price action and volume, then technical analysis can prove valuable. It can help clarify what you might overlook simply looking at the candlestick chart, right? Maybe it helps you spot trends, ranges, overbought, oversold areas, etc. that maybe just simply looking at the candlestick patterns you would have missed, but maybe adding things like RSI or MACD kind of helps you interpret what that past stock performance looked like. So, is there no edge in trading? If I'm telling you guys that you can't predict anything, well, am I saying that there's absolutely no edge to be had? Well, no, there are actually edges in certain aspects of trading that can be exploited. For example, long-term investing. It works. I'm not a long-term investor myself. I like short-term trading, but long-term investing definitely works because all you have to do is buy an index fund and hold it for a number of years, 10 years, 20 years, 30 years. You're practically guaranteed to make money. It's like a 99.9% chance you're going to make money if you hold an index fund for more than a few years. And the reason for that is that the S&P 500, that particular index, which is probably the best market index as far as a reflection of the general broad market, the S&P 500 has only had consecutive down years 3 times since 1957. That's crazy. Think about that. I pulled up a web page here just as a demonstration. So the S&P 500 was created in 1957, but if we go back, We go back to historical annual market returns all the way back to the Depression era. Once we get past the 1930s, the Great Depression and the 1940s, which was World War II, once we get past 1941, there is not a period where we have consecutive years of down returns, except this period right here, 1973 and 1974, we had 2 consecutive down years, and then the dot-com burst of 2000, 2001, 2003. We had 3 straight down years. So really only 2 periods in the last, 80 years, have we had consecutive down years in the S&P 500. So you're practically guaranteed to make money if you're a long-term investor and you simply sink all your money into an index fund. Now, having said all that, I just told you guys I'm not a long-term investor. I prefer short-term trading. So what's my advantage? Well, my advantage is I trade options, and there are advantages that can be exploited in options trading if you use the right strategies. Namely, the advantages in options trading are theta and implied volatility. So theta is the time decay of an option. And if you sell options primarily, theta works for you. If you're always selling options rather than buying options, the passage of time that happens over the life of that trade, it always benefits you. That's an edge. Also, if you sell options when implied volatility is high, that's great because implied volatility tends to revert to its mean. Meaning, if it's higher than normal, it tends to come back down. If it's lower than normal, it's going to go up, right? So if you know that, IV coming down helps short options. So always sell options when IV is high, and you'll make money just because volatility is likely to contract. So that is my edge. So if you're primarily an option seller, theta is always working for you. That passage of time is always working for you. If you're an option buyer, it's the opposite. The passage of time hurts you. It's punishing you. That's why I like selling options rather than buying options, is because I know time always passes. I might as well be on the right side of that trade. And on top of the edge that I have with theta, if I also add a little bit of small edge by selling options when IV is high, then IV, which is likely to decrease during the life of that trade, that's also going to make me a little money. So that's my edge, right? So another edge with selling options is primarily I sell out of the money options. And by selling out of the money options, that provides me a little cushion, right? That provides me a little cushion should I guess wrong on direction. Because if I sell, for example, a 20 delta put, well, I'm going to win on that trade 80% of the time. Even if the underlying stock goes down a little, as long as it doesn't go down below my short put, it doesn't matter. Even though a short put is bullish, right? I want the underlying stock to go up. The stock can still go down and I can win. As long as it doesn't go down below my put strike, I still win. And this is the great thing about options, especially when you're selling out of the money options, is direction doesn't matter. So when I get all these questions about how do you pick a direction? How do you know if you're going to be bullish or bearish or neutral on an options trade? Well, in a lot of ways, it doesn't matter because I'm putting on these really high probability trades that typically I'm going to win 70 to 80% of the time. So direction doesn't matter. I'm not doing a 50-50 coin flip, right? I'm putting on really high probability trades that typically I can win on if the price goes up, the price goes down, the price trades sideways. As long as it doesn't move drastically against me, I can make money. So for options, I could actually argue that picking direction is one of the least important decisions that I have as an options trader. And I certainly don't sit around looking at technical indicators and drawing lines on the screen or anything. For me, it's all about just looking at the candlesticks, right? So if I'm looking at this chart of Google, I've already got a Google position on, and I've got a bullish Google position. I think I've got a short put on right now trading in Google, but you can see why I'm selling a short put on Google. If you look at the last year, Google has done nothing but go up. Now it's choppy, right? It's random. There's some zigzags in there, but overall it looks pretty solid as long term it's going up. So that little bit of, you could call it a little bit of an edge. I think long term it's bullish, right? I've got a bullish outlook on it. Now I could be wrong, right? It's not like I have a magic formula, but just looking at that chart, that looks like a bullish play to me, right? That's all I needed. I didn't need all this crap at the bottom. I didn't need the MACD. I didn't need the RSI, the Bollinger Bands. I don't mind having the Bollinger Bands on the chart because these 3 lines here, they give me a pretty good idea of the volatility of Google. And being an options trader, I like knowing the volatility of a stock. When the three lines, the three bands are narrow, volatility is quite low. When they expand, volatility, of course, is high. But I don't really use any of this stuff to predict anything, right? I can just look at plain candlesticks or even just a plain line chart. And if the line tends to go up, right, that's a bullish play. If it tends to go down, I'll be bearish. If it tends to go sideways, I'll be neutral. And again, because picking a direction is the least important of my decisions, and even if I guess wrong, most of the time I'll still win. Now, one thing I want to just briefly mention is for those of you that want to use technical analysis especially and have all of that, the support and resistant lines, Fibonacci levels, and all that stuff on your screen, please don't clutter your charts, because technical analysis, technical indicators, they cannot predict the market. No matter how many of them you put on your screen, you're not going to crack the code. You're not going to suddenly have the magic formula, right? So technical analysis should never solely determine your trading decisions. Instead, technical analysis should just add a little color to that trading picture that you already have painted in your mind just looking at the candlesticks. For example, me looking at Google and the candlesticks, that's clearly a bullish chart, right? I don't really need to look at anything else, but I could look at the MACD and the RSI and the Bollinger Bands. I could look at some of this other stuff to maybe validate what I already know, that Google looks pretty strong here, right? So as long as you come to technical analysis with the right frame of mind, you know what it is and what it isn't, you can use it, but again, don't clutter up your charts to the point where you can't read the actual candlesticks or the volume bars. I strongly advise against adding too many upper indicators to your chart, because you want to be able to easily read the candlestick patterns. So for example, I've got these 3 Bollinger Bands on my chart, but if I also added 3 more simple moving averages to the chart, now I have 6 lines on the chart, and then maybe I start drawing support and resistance lines. Maybe I'll add some Fibonacci levels. The next thing you know, I've got a million lines on top of all my candlesticks. It makes the candlesticks hard to read. So really be careful with those upper indicators. Don't make it so that you can't actually read the candlestick patterns or the volume bars. For lower indicators, I would say, having 2 lower indicators, if you're going to use them, having 2 makes sense, because you're going to constantly get false signals from each of them. And by having 2, it kind of cancels out the false signals from each. But when you go 3 or more, then you get so many conflicting signals that it just doesn't make sense. So for upper indicators, just make sure you can read the candlesticks. For lower indicators, I would say keep it a maximum of 2. So to wrap things up, does technical analysis help or hurt you? Well, I've stated technical analysis, it has no predictive power whatsoever. So it is unlikely to help your trading, right? Because it is completely useless, it is pointless, it does nothing for you. It's not going to help your trading. So technicians, I know they want to believe that they can find these inefficiencies in market pricing, which will give them some kind of an edge, some kind of signal that they can trade off of. It doesn't exist. And that's because the efficient market theory says everything is already priced to perfection. Because everything is priced to perfection, there is no edge to be had. Thus, if the efficient market theory is true, that means technical analysis, again, it's pointless. But because it's pointless, technical analysis can't really help you, but it also can't really hurt you. And because it can't really hurt you, if you want to keep using all those technical indicators, if you feel comfortable drawing lines on your chart and having MACD and stochastics and all of that stuff on your charts, feel free to continue doing so. Again, it's not going to help you predict the markets, but again, they're not going to hurt you either. So if you feel comfortable using those things, keep using them. Don't, just because I choose not to use them, that's just a decision I've made. But in the end, is it going to make a difference in your trading or mine? Probably not. If you want to learn more about why markets are random, I strongly suggest you pick up a copy of Burton Malkiel's book, A Random Walk Down Wall Street. Again, it's one of the most important books written about trading and investing and the stock market in general. So please check out that book. I'll put a link to it in the description below. And also check out my book, The Super Wheel Option Strategy, available over on Amazon. A link in the description below for that as well. Peace, guys.